The Continental Renaissance, a comprehensive guide to the Vanguard FTSE Europe ETF, VGK. As of March 9, 2026, the investment narrative has shifted from the Silicon Valley supremacy of the early 2020s toward a more global, diversified approach. While the U.S. markets have wrestled with high valuations and AI-driven volatility, Europe has quietly positioned itself as the quality and value hub of the developed world. The Vanguard FTSE Europe ETF, ticker VGK, is the primary gateway for investors seeking to capture the recovery of the old world. Entering mid-March 2026, the fund is navigating a complex but promising environment. Inflation has stabilized at the European Central Bank's 2% target, a historic trade deal with India has just opened new markets, and European national champions in healthcare and luxury are reaching record profit margins. This researcher's deep dive will break down the mechanics of VGK, the macroeconomic tailwinds of 2026, and the specific strategic risks you must understand before committing capital. 1. What is VGK, the blue chip blueprint of Europe? VGK is a passively managed exchange-traded fund that seeks to track the FTSE Developed Europe All-Cap Index. It is a massive, highly liquid vehicle that holds over 1,240 stocks across 16 developed European countries. The Vanguard Edge: Fees and Scale. In the world of 2026, where fee compression is a standard expectation, VGK remains a category leader with an ultra-low expense ratio of 0.06%. For every $10,000 invested, you pay only $6 annually. Diversification. Unlike some targeted European funds that only focus on the Eurozone, nations using the euro, VGK includes the United Kingdom, Switzerland, and the Nordic countries. Assets under management. As of early 2026, the fund manages approximately $32.8 billion, ensuring that even the largest institutional players can enter and exit positions without disrupting the market price. 2. The 2026 portfolio: high-end hardware and luxury liquidity. One of the greatest misconceptions about Europe is that it's a museum economy of old banks and oil companies. In 2026, the VGK portfolio reveals a high-tech, high-margin reality: the healthcare hegemony. Healthcare accounts for nearly 16% of the fund. Novo Nordisk, Denmark, the world leader in metabolic health, in early 2026, the success of their next-generation obesity pill has made them the most valuable company in Europe, rivaling the market caps of U.S. tech giants. Roche and Novartis, Switzerland, these titans provide the defensive ballast for the fund, with consistent dividend yields and massive R&D pipelines in oncology. The lithography moat. ASML, Netherlands. If you're betting on AI in 2026, you're betting on ASML. They hold a 100% monopoly on the EUV lithography machines required to make the world's most advanced chips. Every high-end chip made by NVIDIA or TSMC relies on the Dutch hardware found inside VGK. The luxury standard. LVMH, France. As global wealth continues to concentrate, LVMH has become a consumer staple for the ultra-rich. In 2026, their expansion into the Indian market, fueled by the new FTA, has opened a new growth frontier for French luxury. 3. Macro 2026: the soft landing and interest rate stability. The most critical factor for VGK's performance in early 2026 is the European Central Bank policy. Interest rates at 2%. On February 5, 2026, the Governing Council decided to hold the deposit facility rate at $2.0. This normalization of interest rates, down from the 4+% peaks of 2023, has breathed life back into the European consumer and lowered borrowing costs for the massive industrial companies in Germany and France. the India-EU free trade deal. In late January 2026, the EU and India concluded negotiations on a historic trade deal. For VGK investors, this is a massive catalyst for the industrials and materials sectors. European manufacturers of high-end machinery and renewable energy technology now have reduced tariff access to a consumer base of 1.4 billion people, offsetting some of the drag caused by shifting U.S. trade policies. 4. Performance Snapshot: the 2026 recovery. Following a stellar 2025 where VGK returned over 35%, the fund has entered 2026 in a consolidation and growth phase. Financial vitals as of March 6, 2026. Market price, approximately $84.25. 52-week high, $90.49, reached on February 25, 2026. Dividend yield, approximately 3.5%. European companies historically return more cash to shareholders via dividends than their U.S. counterparts, making VGK a premier choice for income plus growth portfolios. Year-to-date total return, approximately 1.48%. While modest, this reflects a stable, soft landing rather than the speculative bubbles seen elsewhere. 5. Critical risks: the tariff wall and geopolitics. As your AI researcher, I must highlight that Europe's path in 2026 is not without obstacles. 1. The Section 122 challenge. The primary external headwind for VGK in 2026 is U.S. trade policy. Following the implementation of a 10 to 15% baseline tariff on all trading partners, European exporters, particularly in the automotive and luxury sectors, are facing increased costs. However, many European firms have nearshored their production to Mexico or the U.S. itself, mitigating some of this impact. 2. The energy transition costs. The EU is in its independence moment, aggressively pushing for strategic energy autonomy. While the transition to a renewables-based system is a long-term positive, the $500 billion annual investment required for grid upgrades and green hydrogen infrastructure is a heavy fiscal lift that could weigh on domestic consumption in the short term. 3. The China dependency. While the India deal is a win, China remains a major market for German automobiles and Dutch semiconductors. In 2026, as China prioritizes technological self-reliance, European firms are finding it harder to maintain market share, forcing a pivot toward domestic single-market growth. 6. Strategy: how to position VGK in your portfolio. In March 2026, the smart money is treating VGK as a quality value anchor. The value gap argument. The S&P 500 is currently trading at a forward PE of roughly 24 times, while VGK is trading at approximately 17.3 times. You're effectively buying European earnings at a 28% discount compared to U.S. earnings. For a long-term investor, this valuation cushion provides a margin of safety during market volatility. The DCA entry. With the stock recently pulling back from its $90 high, the current $84 range represents a strong technical support level. For new investors, consider a staggered entry, buying in thirds, to smooth out the noise from upcoming ECB meetings in late spring. For income seekers, VGK's 3.5% yield, backed by the national champions of the continent, offers a significantly higher payout than the 1.2 to 1.5% typically found in the S&P 500. Conclusion: the diversified frontier. The Vanguard FTSE Europe ETF, VGK, in 2026 is a story of a continent that has successfully found its own way. By diversifying its trade away from a single superpower and doubling down on high-end healthcare, lithography, and luxury, Europe has built a resilient industrial base. The verdict: VGK is no longer a boring index for people who missed the tech rally. It is a high-quality, low-cost tool for capturing the next leg of global growth at a much more reasonable price point than the U.S. market. If you can handle the short-term tariff noise and believe in the power of the European single market, VGK is a core holding for 2026.